So good evening, everyone. So today we are here to discuss why a AAA rating bond wasn't enough to save PFC. So imagine a AAA rated Indian PSU going to the market and coming back with nothing. So, in April 2025, Power Finance Corporation attempted to raise around 2000 crore using a 10-year coupon bond. Investors rejected the issue by June 2025. PFC officially withdrew it. So, our question of the day, why wasn't a AAA rated bond was enough to save the deal? The case is important because it shows how the Indian fixed income markets actually work beyond the ratings and the reputation. So Rahul will now explain how the Indian context and the timeline go according to it.
Thank you, Saurabh. Good evening, everyone. My name is Rahul, and I will be explaining like Indian content and timeline. So to understand this case, we need to understand the Indian fixed income context. PSU bonds are generally considered as safe investment, and especially for the banks, insurance company, and long-term investors. Looking at the timeline, September 2024, REC Limited successfully raised the bond, and in April 2025, PFC launched zero coupon bond. And in the last, June 2025, PFC withdraw the issue. Um, which this show the bond market was active, and the failure was not because market weak demand. It is because the investor dislike how the bonds was structured and price. So in India, creating credit rating alone does not guarantee success. And I like to Prachit now tell about the fixed income concept.
Oh, thank you, Rahul, to giving me this opportunity to speak about this concept. This is very interesting concept. Today we will talk about S- uh, with the case of PFC. So the first key concept here is duration risk. PFC issued zero coupon, which means there are no interest events uh, only after 10 years. Because of this, as uh, it makes as for the investor. So let me explain with this simple example. When the asset changes, the price of the long duration bond a lot. Yeah, where the investments can be right. So investment typically prefer regular bond rather than waiting long tenure, like 10 years, for a single payout. So even though default risk was low, the timing risk and the interest were quite high. So that is why yes, as attractive for investors and uh, has kept the picture. So Subham, would you like to add something on it?
Thank you, Prachit. So the second concept is the yield price relationship. So investors demand a yield of 7.02%, but PFC was offering only 6.90%. So this spread that killed the deal. So this 0.12% difference may seem smaller, but with a duration bond, price sensitivity is very high. So in the bond market, when required yield rises, the bond price falls. So PFC did not adjust its pricing, so investors chose not to participate. And now, Karthik, now let's evaluate the impact and the final decision.
Yeah. So to end with, let's evaluate the impact of what these decisions led to. So for investors, it avoided long duration risk, as well as it protected their overall portfolio value. When it came to Power Finance Corporation, it failed in its fundraising attempt, and also it missed an opportunity to tap into the market to raise funds. For the bond market, Indian bond market, the reinforcement of price driven, uh, sho- showing the rating not override yield expectations. The trade off was PFC wanted to borrow at a lower cost, but rejecting the market required yield resulted in zero funds raised. The recommendation was the PFC should issue regular coupon bonds instead of zero coupon bonds. This reduces the duration risk and better matches Indian investor preference. The final conclusion for this would be in Indian fixed income markets, pricing matters more than prestige. Even AAA rated issuers must respect the market determined yields. Thank you.